just a quick primer on this guy. When you go for jobs in a finance role, everybody will question your understanding of valuation. He is a professor at NYU. He's considered the dean of valuation. That's what he's considered. Okay. He is the authority on valuation. He's written so many books. I mean, I have a book in my bag. I'm not even kidding. Like, I keep this with me because there's concepts. This is a great book. Okay. You keep this with you. It's called Investment Valuation. It says tools and techniques for determining the value of any asset. I keep it with me. I did valuation for 4 years as a professional. Okay, I know valuation cold. There's no problem with me knowing valuation, but having this book is a great resource for me because there's times like the other day I was working on a project and the company was new. It was a growth company. It's only 2 years old. Started by two guys, 25 and 27 years old. And there's a lot of growth. And I was like, I haven't valued a startup in a while. So I needed those, like the reinforcement, So it's like a little text, and I just kind of go back, and he has a whole section on it. It's got 25 pages on how to value a growth company. So, am I going to take his word for word and do it? No, but at least going to kind of give me a good sense of it. So he's fantastic. Another thing, his classes at NYU are all public on YouTube. So this is amazing. You do not have to be an NYU student to learn from this guy, okay? All of them are there for many, many years. So again, when we talk about story, when we talk about passion, when we talk about having an interest in something, if somebody says, tell me about relative valuation. What is a market multiple, Ash? You can say, well, funny you brought this up because I've been watching Ashwath Damodaran's classes at NYU for the past 6 months. And he mentioned, and then you go into it. What is that signaling? What's that story? That you're passionate, you're doing this in your free time, you're interested, and you're probably better than the next person, right? Okay, super, super important stuff. This is the kind of things you have to do. You've got to be determined, passionate, and really want something. So I'm going to play this video. It's like 18 minutes long. So I just want to play this. This is good. He's good.
So let's say you decide to buy a house. You hire a realtor. The realtor shows you the house. And then he or she gives you a number, 500,000. How do you think she came up with that number? She didn't do an intrinsic valuation of that house. She basically came up with that number looking at other houses in the neighborhood that had sold in the recent past. That is the essence of relative valuation. In relative valuation, you value an asset based on how similar assets are priced. In contrast, in intrinsic valuation, you valued an asset based on its cash flows, growth, and risk. The two are obviously interconnected, but they're not always going to give you the same answers. Most analysts who do valuation do relative valuation, and many of them do it badly. In this session, I hope to take you through a 4-step process to make sure, if you use relative valuation, that in fact, you're dotting your I's and crossing your T's. So we've talked a lot about intrinsic valuation, right? And I don't blame you for thinking about intrinsic valuation as the only way to value a business. I like intrinsic valuation, but in this session, I want to introduce you to the technique that most people use to value businesses, which is relative valuation. What is relative valuation? Well, here are the basics. In relative valuation, you value an asset based not on its cash flows, growth, and risk, but based on what similar assets are priced out there. If you use StubHub to buy a ticket or eBay to buy something, you're doing relative valuation. You don't try to value the asset, you look to see what other people are paying for something to decide what it's worth. In the context of valuing assets, here are the 3 pieces you will see in a relative valuation. First, you'll see a standardized price. What do I mean by that? Let's say you're buying a house. A 5-bedroom house will cost you a lot more than a 2-bedroom house. So rather than compare the prices of houses, we look at price per square foot. So first you have a measure of standardized price. Second, you have a set of assets that you call comparable. You're saying these are similar assets that have traded and these are the prices they traded at. And I would put quotes around the word similar because there are probably differences, even if you're very careful about your choices. you're probably still going to see differences. And the third step is if you're careful, you'll control for those differences. So there's a standardized price, there are comparable assets, and there are some ways of controlling for differences across assets. That is the essence of relative valuation. If you ever read an equity research report, you know what I've just described, right? The standardized price usually takes the form of a multiple. The similar assets are usually called comparable firms, and the controls are usually storytelling. But that's relative valuation. Now, before I delve into relative valuation, I should also tell you that relative valuation is pervasive. It's all around us. In fact, to show you how pervasive it is, I'll give you a couple of statistics. About a decade ago, I collected about 550 equity research reports from around the globe, different investment banks, different equity research houses. I must confess, I didn't read most of them. I collected them because I wanted to categorize how equity research analysts approach valuation. Out of the 550 equity research reports, about 45 were discounted cash flow valuations, less than 10%. About 450 were relative valuations, a multiple and comparables. The remaining 55 were kind of fuzzy. I couldn't quite categorize them. But among the ones I could categorize, 10 to 1, relative valuations outnumbered discounted cash flow valuations. I took a look at about 100 acquisition valuations, hoping or expecting things to be different in corporate finance. Out of the 100 acquisition valuations, I got a much more even split. About half were discounted cash flow valuations, half were relative valuations. But then I took a closer look at the half that were discounted cash flow valuations, and I noticed that in most of them, the biggest number, the terminal value, was estimated using a multiple. So even those were really relative valuations. Almost every rule of thumb you see out there is based on a multiple, right? What am I talking about? Price to book less than 1 is cheap. A price earnings less than 10 is cheap. They're all based on multiples. What I'm trying to say is the language of valuation around us is the language of relative valuation. So when I first ran this statistic, I was a little puzzled by my finding, and here's why. When I teach my valuation class at NYU, I always end every class with a question. And this is after everybody's valued their companies using multiple approaches, discounted cash flow valuation, relative valuation, whatever other approaches they might use. So I asked them at the end of the class, after they've tried these approaches, if they had to pick an approach, which one they would pick as their preferred valuation approach. In the 25 years I've taught the class, I get pretty much the same answer. About 70% pick discounted cash flow valuation or intrinsic valuation, reflecting, I guess, my biases. About 20% pick relative valuation, about 10% are not quite sure. So 7 to 2, when people leave my room, they say they're going to use discounted cash flow valuation. I haven't done a follow-up questionnaire, but if I did a follow-up question 5 years later and asked these people on their jobs, I don't know what jobs they're at, what approach do you use to value companies? I'll wager the numbers get switched. That 70% use relative valuation and maybe 20%, maybe, still use intrinsic valuation. So I started thinking about what it is about relative valuation that makes it so attractive to analysts. And I've come up with 3 possible answers, and feel free to add to this list. The first one came to me while I was watching a Seinfeld episode. One of those episodes where one of Jerry's many girlfriends accuses him of being crazy. He says, "Jerry, you're crazy." He says, "If you think I'm crazy, you should see the guy who lives across the hall from me." And if you've ever seen a Seinfeld episode, you know who lives across the hall from Jerry, right? It's Kramer. And relative Kramer, who's crazy? You're saying, what's this got to do with relative valuation? We forget how much of valuation is selling, right? So if you're trying to sell me something, it's far easier to sell me something with a relative valuation than an intrinsic valuation, because here's all you need to do. You need to find something even more overvalued than what you're selling me. You say, look, it's cheap. It's cheap relative to these 5 other things I found out there. Relative valuations are far easier to sell than intrinsic valuations, because as long as you let me pick the multiple and you let me pick the comparables, I can tell you whatever story I want to tell you. Second, it's far easier to defend a relative valuation than an intrinsic valuation. And here's why. In intrinsic valuation, your assumptions are all explicit. Everybody can see what you're assuming about cash flows and growth and risk, and that's dangerous because they can pick it apart. In relative valuation, all your assumptions are implicit. So when you use 12 times EBITDA, you are making assumptions, but nobody can see what those assumptions are. And if they cannot see them, how can they pick them apart? And third, and this is something that we don't factor in enough when we think about valuation. I personally think in the long term, you're far more likely to be right with intrinsic valuation than relative valuation. But here's the catch. When you're wrong with intrinsic valuation, you're also far more likely to be wrong alone. You're saying, so what? If you're wrong alone, you tend to be fired. If you use relative valuation and you're wrong, you're always going to have lots of company. And that's a safe place to be. The survival instinct kicks in. And that's why I think more people use multiples than intrinsic valuation. Even if you're a true believer in intrinsic valuation, here's my advice to you. Understand relative valuation. Keep it in your arsenal. It doesn't have to be an either or. I am a true believer in intrinsic valuation, but I still do relative valuation. I'll often frame my intrinsic valuation in terms of relative value. So don't give up on relative valuation.
So I just should have pointed that out. He is, Peter's reminded me as well, that he is the, intrinsic valuation, discounted cash flow and all this kind of stuff, right? That's really what he's focused on. But I like, yeah.
So he's basically just saying everything's like really, really subjective, and you can pick 10 that are just hot pieces of junk, and oh, this one's better than that one because it's the best of the worst.
Exactly. So you have to think about the parties and the counterparties, right? Investment banking, you selling a business. Are you going to want a group of high multiple businesses or low multiple businesses when you're trying to sell them to market them to potential buyers on what the value is?
The high one.
Higher multiple, right? If you're a buyer of that business, now I'm the counterpart, I'm the private equity firm. You think I'm going to look at a set of higher value or lower value when I'm buying the business? What am I going to be more interested in? We're trying to negotiate with you.
Okay, the one.
Lower valuation, okay? So you see how this interplays between two parties, party and counterparty? Super important. I just like how he kind of walks through these things because you need to kind of hear it from him, who's this kind of cash flow guy, but he just recognizes that you got to understand this. It's more important, to be honest with you, because this kind of cash flow is not done as much. It's just not. I mean, I work in private investing. It's just not, and it's 9 out of 10 times it's relative valuation. But you need to know how to do it because you have to.
So let's talk a little bit about how we can bring relative valuation into our toolkits. Before I talk about the 4 basic propositions or ways in which you can prevent yourself from making mistakes with relative valuation, let me first go back and talk a little bit about multiples. As I said, to make comparisons across companies, you got to use a multiple. And every multiple is a numerator and a denominator. And here's the way to think about it. In your numerator, you almost always need a measure of market value. That market value can be just of your equity, that's market cap, as is the case with price earnings ratios. It can be market value of equity plus the value of debt, which is the market value of the firm. It can be market value of equity plus debt minus cash. That's called enterprise value. So in almost every multiple, you're going to see one of those 3 numbers: market cap, value of the firm, or enterprise value. The difference between enterprise value and firm value is enterprise value is net of cash. So it's firm value minus cash. In the denominator, you can see one of 4 measures. You can see revenues because you're wary about accountants and what they can do to the bottom line numbers. You might see earnings per share, operating income. No, you might see even measures of cash earnings, EBITDA. You might see book value of equity or book value of the entire firm, or you might see some sector-specific measure. What am I talking about? Remember the late 1990s when .com companies were compared based on value per website visitor? You can compare steel companies by dividing the market value by the number of tons of steel they produce. But basically, it could be some measure of operations, market value per employee, market value per unit output. But in all of these measures, what you're trying to do is you're trying to scale market value to some common variable. That's the first step in relative valuation, is to get a sense of what those multiples are. Because I'm going to take you through a 4-step process that if you're religious about following, you're going to be okay with relative valuation. Because my problem with relative valuation is not that people use it, but that they're shoddy about the way they use it. And here are the 4 steps I'm going to go through. I'm going to start off by defining the multiple. I don't mean to be insulting. You're probably saying, I know what the PE ratio is. I know you do. But your definition of PE and my definition of PE might be very different. I'm going to describe the multiple. Sounds fancy, right? But I'm going to use Stat 101. I'm going to put up a histogram. I'm going to count the number of companies with P/E ratios between 0 and 4, 4 to 8, 8 to 12, put it on a distribution. Because the distribution is going to tell you some very interesting statistical things about multiples. Then I'm going to analyze the multiple. I'm going to argue that embedded in every multiple are all of the assumptions you made in discounted cash flow valuation about cash flows, growth, and risk. I'm going to make your implicit assumptions into explicit assumptions. And only then am I going to apply the multiple. Define, describe, analyze, apply. In too many cases, you see analysts trying to apply a multiple without going through the first 3 steps, and that's what gets you into trouble. Let's start with defining the multiple. When I look at a multiple, there are 2 basic questions I ask. The first question I ask is this multiple consistently defined? Let me explain. As I said, every multiple has a numerator and a denominator. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. You have no idea what I'm talking about, right? Let me back up. Let's take P/E ratios. Think of what's in the numerator. It's a market value of equity, right? And in the denominator of earnings per share, which is equity earnings divided by the number of shares, which is okay. Thank God for small blessings. The most widely used multiple in the world is consistent. Or EV to EBITDA. In the numerator, you have market value of equity plus debt minus cash. A rough measure of the market value of the operating assets in the company. And in the denominator, you have earnings before interest, taxes, depreciation, and amortization. A rough measure of operating cash flows, EV to EBITDA is okay. So here's what's not consistent. A price to EBITDA ratio. And here's why it's not consistent. Your price is a market value of equity. EBITDA is an operating cash flow. You say, what's wrong if I use it and I'm consistent? I use it for all 15, 20 companies in my sector. It's not going to work. And here's why. If you have companies that borrow a lot of money, let's say they borrow money to buy back stock, the market value of equity will drop, right? But their EBITDA will not be affected by the borrowing. Those companies are going to look cheap to you. If you mismatch your numerator and your denominator, use equity value in the numerator and use a pre-debt value in the denominator, you're going to find companies that borrow a lot of money look cheap to you for all the wrong reasons. So check your multiple to make sure it's internally consistent. Second, make sure it's estimated exactly the same way for all 15 companies in your sector. It's actually a tougher test to meet than it sounds. If you're using price earnings ratios, here's what I'm asking you. Is earnings per share estimated exactly the same way for all 15 companies? That doesn't just require that you have the same accounting standards, right? You need all companies to have the same amount of fidelity to those accounting standards. If they don't, aggressive companies are going to look cheap to you. So watch out. Second step in the process, describe the multiple. As I said, this is basic statistics. When you have a lot of data, put it up in a distribution. Because what you're going to get a sense of when you put up this distribution is what's high, what's low, what's typical. One of the things you're going to see when you put up the histogram, and you're going to see a few in the next few sessions of each of these multiples, is none of them is symmetric. Why? Because a multiple can never be lower than 0. A price earnings ratio cannot be less than 0. But it can be 15,000, 20,000, 25,000. You're saying, so what? When you have a distribution where the lowest value is 0 and the highest number could be any number, your averages are going to get pulled out by those outliers. I remember what my stat professor said in my first statistics class. He said, if you have an asymmetric distribution, a distribution where the outliers are all on one side, he said, trust the median, not the average. So we'll look at the statistics of these distributions, but it's good to look at the data. 25 or 30 years ago, you could have had the excuse of saying it's too much work. That's no longer true. Today, we have the data to look at, and there is really no basis for rules of thumb if you don't have the data to back up those rules of thumb. So that's the second step. Look at the distribution, make sure that the distribution meets your characteristics. Third, analyze the distribution. As I said, embedded in every multiple are all of the assumptions you make in discounted cash flow valuation. Assumptions about cash flows, assumptions about growth, assumptions about risk. There are 2 questions you're trying to answer here. When I use a multiple, what are the variables that should determine that multiple? Second, how do changes in those variables affect my multiple? So for instance, if you tell me that the variables that matter are growth and risk, how does change in growth affect this multiple? You think that's going to be really difficult to do. Not really. Here's a very simple rubric you can use for finding out the variables that drive a multiple. If you have an equity multiple, price earnings ratio, price to book, go back to a very simple equity valuation model. The simplest one I can think of is a dividend discount model, a stable growth dividend discount model. The value of a stock is the expected dividend next year divided by the cost of equity minus the growth, right? Divide both sides of that equation by a constant. So for instance, if I divide both sides by earnings per share, I end up with an equation for the price earnings ratio. That'll tell me what the variables are that drive the price earnings ratio. If I have an enterprise value multiple, go back to a very simple enterprise valuation model. Enterprise value is free cash flow to the firm next year divided by cost of capital minus growth rate. Do the algebra. As you will see in the coming sessions, that's going to allow us to come up with the variables that drive each multiple. And once you have those variables, the rest becomes straightforward. You can control for differences. You can look to see why some companies are cheap and others are expensive. So define, describe, analyze. And if you go through these 3 steps, then you're ready to apply. And when you get ready to apply, there are 2 basic questions you have to answer. What am I going to call comparable here? What are those comparable firms? And the answer might seem simple. You might say, I'm a software company. It's other software companies. But that's not necessarily the truth. A comparable firm from a valuation perspective is a company with similar cash flows, similar growth, and similar risk. And guess what? If you're Microsoft, none of those companies might be software companies. So think in fundamental terms and think of ways in which you can control for differences on those fundamentals. Storytelling is not going to be enough. So one of the things we're going to talk about in these coming sessions is how to control for differences in ways in which it goes beyond the storytelling. So let's review. Most people use relative valuation and most people use it shortly. So if you're going to use multiples and comparables, and I think it's a good idea to know how to do it at least, even if you're a believer in intrinsic valuation, remember the 4-step process. Define the multiple, make sure it's consistently defined and uniformly estimated. Describe the multiple, think of its statistical properties, look at what's high, what's low, what's the median. Analyze the multiple, see what variables drive this multiple, and only then should you use that multiple in application.
Okay. Just comments on that, thoughts, anything anybody wants to talk about? Anything so far? Questions that anyone has? Yes.
About like valuations and what happens.
Whatever, anything we've talked about this morning. Anything you have a question on? Anything?
I think he assumes that a lot of people don't even know what they're talking about. They're really just like, oh, I saw this on, let's say, Bloomberg. This looks good. Let's compare it against these 5 because they're in the same sector. But one of them, like whatever the 50 times earnings might be okay. Meanwhile, other companies, whatever they're doing on the accounting side, would give them that number, but it's not okay.
Right. So what Aaron brings up is a good point, because if a company is investing a lot today, I was using Airbnb as an example. So I think Airbnb is a great company. Why? It's the most trafficked, I guess you would call it, vacation hotel company. They're disrupting the hotel industry. They allow people to make money on their homes or rental properties. And you mentioned what, Aaron, Wyoming?
Okay.
Montana. Okay, Montana. That's a good example. Is this a vacation place?
Yeah.
Okay, but now if in pre-Airbnb, right? What would you do with that?
I mean, you have to hire pest control.
Right. But let's say it's like 1995, pre-internet. I mean, you're not renting. Yeah, exactly. So it allows a homeowner to generate revenue, right? To generate income on a home. It allows you to buy a home and then use it as an investment property now, right? As a vacation spot. So it's kind of really interesting. Airbnb has kind of spent a lot of money to set all this stuff up. So in the future, it should really be a lot of maintenance, is my point. But to Aaron's point, if something trades at 50 times earnings, people question Uber, right? Uber is a good example. Why? Because Uber has a relationship with their drivers. And now if the drivers have to be recognized as full-time employees under Uber, that hurts earnings, because then Uber has to provide sick days and vacation days and health insurance, let's just say if you're full-time. There's also tax implications for them as well. So people are always kind of wary of the Uber model as being sustainable long-term. Can we generate these earnings long-term? Just obviously something to think about. Any other questions or thoughts or anything like that so far? Okay. What did you think about that video with what he said? Did it help clear anything that makes things more confusing? When he gets into the math, I've always feel like, I know he's a well-regarded professor at NYU, and he's made a ton of money in his life, but no one breaks apart a multiple like that. You know, how he does it. Conceptually, it's good to know because you got to understand what is being baked into this. But multiples are how comfortable the investor is on making an investment. Growth, risk, reinvestment, these are things that are important. What's the growth of a business? What's the risk of those cash flows? How profitable are they? These are the things that people are going to take into account when they're thinking about valuation. Yeah.
So with DCF being like not really used, like you said, is it just because people just get kicked out of the crowd, like you were wrong? Just rather DCF you're wrong on your own, or if you're wrong with multiple, you're wrong with the crowd. So you kind of talk about security that way.
Yes, exactly. It's important. So, and just before I get to you, I just want to add one more point to that. Valuation methods, it's good to have multiple ways to get to something. So this way you got to know how to do this kind of cash flow analysis evaluation, because somebody will say, hey, how'd you get there? Well, we did this value, and we did it this way, and we did it this way. And these three, they gave us a range of values. There is no, if anybody tells you this, if anybody tells you that the value of this company is $100 million, run away from that person, because there's no way that you can get a spot estimate, a spot price, and say, hey, that's what it is. It's not possible. There's a range of values that you have to come up with. So precedent transaction, which we didn't talk too much about before, precedent transaction is if companies like yours were sold in the past, companies like yours were sold in the past, how much did they sell for? What kind of multiple did they sell for? Sorry, I think I lost my chat real quick. Oh, there we go. Yeah. Okay. Just wanted to kind of keep this off to the side. Okay. Any other questions? I'm sorry. What were you saying, Joe, about that?
Then why
Kind
is it
why do it?
Yeah,
It's just to have multiple.
approaches.
Yeah.
Gotcha.
Did you have something else? Susan?
So what I find interesting about the stock market, it's how like been into it for a while, and Joseph will say Chris spoke about it too, someone else about trading. How like it's a lot of self-preservation, so they'll use the same things over and over again to keep themselves relevant.
Yes, exactly.
And then they go into the stock market. I find it funny how like 1 month, like all that BS is allowed to fly, like 2005, whatever,
Right.
200x, and all of a sudden they say, oh no, they're really doing this. Like
Yeah.
how they,
So I think that's what I was saying about narratives.
yeah.
So I don't like technical analysis when it comes to stocks because I just don't think it's meaningful, my opinion. However, price dictates narrative. Okay, the stock market goes down tomorrow, 20% crash, they're going to find something. There's the next month, the market rips higher, 20%. I can just explain to very quickly. Interest rates were rising in February. Okay, tech stocks declined. Everybody said, well, when interest rates go up, all of a sudden now this is the narrative. When interest rates go up, tech goes down. This is the narrative. Okay. Go back over the past 7 days, 8 days. Look at where interest rates are. Look where they were 2 months ago. And look what the NASDAQ has done in the past 7 days. NASDAQ's probably up about 5%. I don't know what it is today. It's probably up 5% in a week. Yeah. Well, where's the correlation? Where's that conversation? You told me this. This is what the market, this is narrative. So what I'm saying is that price dictates narrative. I always just say it's all noise. It's all noise. It's for fear mongering. The media has to kind of talk about something. And think about it. If CNBC didn't create a narrative, Aaron, right? Like, well, what the hell are they going to talk about every day? So people get very negative on the media. They say, oh, they create fake narratives and this is BS and that's BS. I kind of look at it just from a business perspective. I mean, they're making money. I mean, like, If the media doesn't create a narrative on something, well, what the heck are they going to get up there and say? Oh, today Amazon's up 10%, and then they just said nothing, right? Like,
Well, they kind of have to say the whole thing is kind of BS.
yeah, exactly, right. So they have to create a narrative. Oh, there was an announcement of something that happened today, and now that was the reason why. So, I'm sorry, you had a question?
Oh.
No?
It was related to the CS and the relative-
Yeah, go ahead. Go ahead.
But like when he was talking, he said when he asked questions, like when he surveyed the class, most of the students said they would use like the DCF model. But he said if you check later with them, they would most of them would use the LCF. And I think that kind of stuff too, because I think there should be a balance. Because if you're just looking at like two companies on a different, you can never truly compare them relatively.
Yeah,
So
absolutely.
at some point, it should be conducting a DCF for companies to really understand the value.
Yeah, and it's a data point, right? DCF is one data point, relative value is another data point, and you kind of use this to kind of test yourself to understand things. Does this make sense? Think about sanity checks, right? If you come up with a DCF of something, let's say you value a business through a discounted cash flow analysis, come up with 100 million. What does the multiple imply? Are you 100 million of enterprise value divided by what the EBITDA is? And let's say the EBITDA is 2 times. Let's say EBITDA was 50 million and you came up with a DCF of 100 million of value. That's a 2-time multiple, right? 100 over 50, right? Yeah, it doesn't make any sense. Let's say the company's growing revenue at 25% and EBITDA margins are 30%. Nobody would sell the business for 2 times. You did something wrong, right? That's how you have to think about it. This is wrong. So you're going to go back and look at your inputs and your DCF and what was your what was your WACC and what were your cash flows like, and was there anything else that you messed up? And maybe after you fix a few things, this comes up to 500. And you're like, oh wow, now it's 10 times. Oh, that makes more sense now. And then you looked at the market, right? And you looked at the comparable, and we said there's no directs, but let's say the directs are 8 to 12. What do you think now about your DCF? You came up with an implied multiple of 10. The market's trading 8 to 12. You're going to feel what? Confident, right? You're feeling good now. This is okay. I'm in the right realm of reality here. This makes a lot of sense. This was just I'm showing here is just a Bed Bath & Beyond. This is from JP Morgan, actually. It was an old one. Price target here that they had. Why am I showing you this? See here, they kind of go through this analysis and they talk about the business and like what's going on. But kind of here, I just kind of want to see, he says here, valuation. Our December 2016 price target of $51 is based on approximately 10 times our enterprise value forecast at par, meaning on level with the market's current valuation and equivalent to a 5 times EBITDA multiple. These levels are also consistent with other e-commerce at-risk names, ranging from Best Buy to certain department stores at GNC. This is JP Morgan. JP Morgan is a bunch of Ivy Leaguers, and William Patterson student for sure. But now this person who wrote this, I mean, we can probably look him up. Christopher Horvers, Tammy Zakaria, Mark Bex, just like where they go to school, like what did they learn? Because this is such nonsense to me. Like, just think about what they're saying. These levels are also consistent with other e-commerce. First of all, e-commerce. Let's just start there. Like, Bed Bath is one of the I don't know. Is Bed Bath an e-commerce business?
Not really.
I mean, now they've transformed this business to be more, but in 2016 they weren't. And they call it e-commerce at risk. So what does that mean? What does e-commerce at risk mean? I don't even know if you should know. I don't know. It's just a risky, And then they compare it to from Best Buy to GNC. So, like, what does Bed Bath sell? Towels. What does Best Buy sell? What does GNC sell? Fake weight loss stuff. Yeah, vitamins, supplements. Like, do you think GNC and Bed Bath and Beyond are comparable at all?
I mean, we go back to what the guy said. It might like the business model. I don't know what they sell may not match, but maybe the numbers just are similar.
Yeah, so he says that I don't agree with him. Why? Because your business, if I sell vitamins, my business is a lot more over the past 5 to 10 years has been a lot more. That business has gone online. Like you don't need to go to GNC to buy vitamins or weight loss or protein powder. People just order it online through Amazon or somewhere else. Bed Bath, people buy things like that online. Sure, of course. They buy towels, they buy curtains, they buy plates. But I still think people generally are going into stores and still buying this sort of stuff. Yep.
So can I say something interesting about the stock trading analysts and all this, right? Like my friend Andrew, he always says, like, if you think you know something, right? There's thousands of people who know more. So I'm just looking at the price chart from, Bed Bath and Beyond to that time, right? That was obviously when e-commerce, the big shift was coming, right?
Right.
And that store was gonna go. So if you look, you definitely had like short action on the stock. People were shorting it because it was about $80 a share a couple times during that time frame. So if this guy recommended the stock because he had access to an incredible amount of data of his team, they were right. But if you were going to hold on to that stock long term, you got hammered.
Yeah, the stock today is probably
It's up
30. Yeah. So, my point is when you do relative valuation, you can see the stock's 30 now. Stock during COVID in March went to 4.
Yeah.
So, look, you can't blame JP Morgan didn't foresee COVID 5 years ago, right? But my point is that when you play this relative game and, like what are they saying here? Investment cycle finally peaking, but share and price pressure remain. And they kind of go over the quarter and the initiatives that they're taking. But long story short, it's just not so easy to kind of take a look at this. So